You don't have the best credit score, or you have no credit at all. You haven't saved much money for a down payment. Everyone's hating on you. You're never gonna be able to buy a house, right? Wrong. We actually have some great news for you today. We're gonna talk about the FHA mortgage and what it could do for you. I'm Andrew Russell, owner and founder of RCG Mortgage, Broker of the Year winner, top originator through Scotsman Guide. But first, before we get into it, make sure you like, subscribe, and comment below, guys. If you don't subscribe, it's guaranteed your property taxes are gonna go up. So an FHA mortgage, what is it? Let's get into it. So what is an FHA mortgage? FHA is the Federal Housing Administration. It is a mortgage type that is super popular. It actually really came off the ground after the 2007-2008 crash. Why? Because it's amazing for a multitude of reasons. It's backed by the government. It's typically got lower interest rates than the conventional, Fannie and Freddie type competitors. It's an amazing mortgage. So what does it take to qualify for an FHA mortgage? We typically go over credit, income, and assets. So credit, FHA is very liberal on the credit score that it requires to purchase a home. With a 580 or higher credit score, that's right, a 580, not a 680, a 580 or higher credit score, you can buy a house with as little as 3.5% down. Now this is specifically for a 1, 2, 3, or 4 family house, maybe a condo. There's a lot more guidelines as it relates to condos, but it is not for a co-op. So that's the credit score requirement. You can actually, with 10% down, buy with a 500 to a 579 credit score. But of course, 10% is a lot more than 3.5% down, right? The second piece is the income. So to keep it simple, FHA reviews a 2-year job history. If you're self-employed and own a business, typically FHA is gonna go off of your net versus your total revenue. So it just means if you're self-employed, typically it's a little bit harder to get an FHA loan. If you're a W-2 employee though, what do we check? We check your salary. Are you hourly? How many hours do you work a week, right? Overtime, bonus, commission. There's a whole Boolean math. Nonetheless, once we determine how much you make a month, FHA allows for up to almost 47% of your monthly pre-tax income for a mortgage payment. So as an example, if you make $10,000 a month, they'll let you in certain instances have up to almost a $4,700 a month mortgage payment. They actually base their numbers off pre-tax monthly income. And then they only allow for other debts, right? Which are credit cards, student loans, car loans. You can only have a certain percent of those as well. That's what we use for qualification. There's certain max metrics that we go off of, a max amount of debt versus your income per month. Third piece is assets. Very simple. They look at 2 months of assets. If you have large deposits, we ask for you to source them. We want to make sure you didn't go to Vegas and win a poker game and then you deposit your money, you didn't claim it. There's a lot that goes into it. But typically we look at 2 months of your assets. We ask about some large deposits here and there depending, but that's what we use to see if you have enough money to close. Some food for thought though with FHA mortgages, you don't have to be a first-time buyer to get it, but if you're buying a second property, they do not allow you to use rent income to wash your current mortgage payment on the house you're vacating unless you're moving over 100 miles away, which is probably not the case. So typically, it's the perfect mortgage for a first-time buyer. There's also loan limit maxes, depending on the county you're buying in, the amount of units in the property, whether it's a 1-unit property or it's a condo or a 2, 3, or a 4 family, there are certain levels of max loan amounts that we have to make sure we stay under, which is a big caveat. Here in New York, we have different loan amounts than maybe North Carolina. So again, it's just food for thought. Here's an example of a client that we had. Their credit score actually went down. Why, you ask? Because they co-signed for the student loans for their son. Their son graduated college, didn't realize, guess what? You actually have to pay back the student loans. The parents didn't know, the student loans went late, and their credit score went from a 740 range down to about a 600. So what happened? They're all bummed out, but we actually we did a pre-approval consult for them, and we figured out they actually qualified for an FHA mortgage. And it turns out they were able to put less down as a down payment on that FHA mortgage. The interest rate was a quarter better than if their score was still in the 700s with a conventional mortgage, and the deal they got was actually better by doing an FHA purchase. So as you can see, guys, an FHA mortgage has completely taken over the marketplace. It's an amazing mortgage for anyone who has maybe not the best credit or not that much money from a down payment perspective. We turn frowns upside downs. FHA is definitely here to stay. Make sure you like, subscribe, and comment below, guys. Any video ideas, let us know. We'll definitely work on that for you. But until the next video, see you then.